So earlier this week, I made some pretty big moves in the portfolio, guys. I sold out of 3 different positions, and there were a couple different things I did with the funds from that. First, I reinvested a substantial portion into one of my existing stocks and significantly beefed up that position, which was really cool. And second, I used the rest of the funds to actually start a brand new position. In this video, we're going to go through all of these changes, guys. We'll talk about the stocks that I sold, the ones that I bought, and how these changes impacted my overall portfolio. It's going to be a lot, and I'll be curious to hear your thoughts on these moves in the comments below. So before we get into the 3 stocks that I sold, first I want to clarify that these companies are not by any means bad investments. They've actually all done pretty well for me. My decision to sell these companies had less to do with the quality of these businesses, and it had more to do with the overall construction of my portfolio. And I know that doesn't paint a great picture for you here, but hopefully as we go through the video and talk about each of these stocks, it'll make more sense. And with that, guys, believe it or not, the first stock I decided to sell out of was Apple. It's true, and there's no denying that Apple is a solid business. And like I said, it's one that's done pretty well for me. Looking at the screenshot here, we can see that I first started buying this Apple position at the end of 2022, going into 2023, somewhere in the mid $120 range. And I ended up selling my position on July 2nd. So all in all, I held this Apple position for just over a year and a half. And if we take a look at the sold positions page over here on my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to download this spreadsheet in the description of the video. But over here on the sold positions page, we can see the full transaction details for what I did with Apple. And at the time of selling, I had 6.64 shares at an average cost of $129.45. Really not too shabby, and I sold it exactly $219 per share. And as we can see, since then, the share price has gone up a bit, so maybe I should have held on another couple of days, but still, even so, guys, I made out pretty well with this Apple position. All in all, I ended up with a share price return of 69.2% and a total return of 70.3%. So overall, Apple was a really strong performer in my portfolio, which definitely begs the question, if it was such a solid performer, why did I sell out of it? And the gist of it, guys, is that Apple was such a small position in my portfolio. I think upon selling, it was maybe somewhere between 2 to 2.3% of the portfolio's total weighting. So really not a huge position at all. And it had run up to the point, the share price had run up to a point where I realistically wasn't going to add any more to this position, which is a good problem to have. But this means that as my portfolio continues to grow, that already small position would over time become even smaller in the portfolio, which means its ability to move the needle would become less and less. And so overall, even though it's been a great investment for me, I thought that right now would be a good time to lock in those gains, free up that money, do a little bit of consolidating, and then reinvest that money into another position in my portfolio that I've been wanting to build an even bigger position in. Which brings me to the next question that we need to answer. How did I reinvest the proceeds from selling Apple? Well, guys, I ended up putting all of that money right into Visa. With the money that I had from selling Apple, I was able to pick up almost 5.5 more shares of Visa at an average cost of $264.14. And as we can see here, in doing so, this has made Visa the largest individual stock position in my portfolio, which has been my goal with this stock the entire time. I always wanted it to become my largest individual holding. And now after adding these 5.5 shares, I'm left with 20.4 shares of Visa. And it now makes up about 7.8% of my overall portfolio, just there above Realty Income, just there above Johnson & Johnson and Starbucks and Williams-Sonoma as well. So I'm really happy to see how these core positions are shaping out. I think this is a really solid top 5. And on the dividend side of things, in selling out of Apple and reinvesting all of that money right into Visa, I was able to reinvest into something with a slightly higher yield. As we can see here, Apple's at about 0.5%, just under 0.5%, whereas Visa's more like 0.75%. Neither of them are high yields by any means, but still, we'll take what we can get. And also, Visa has a much higher dividend growth rate than Apple. It's not even close. It's almost like 3 times the 5-year CAGR compared to Apple. But anyway, guys, in addition to Apple, there were still 2 other stocks that I decided to sell out of, and those 2 were CocaCola. Believe it or not, I did sell out of CocaCola, and I also sold out of the Southern Company, 2 really iconic companies. And when I was first getting into dividend investing, these were 2 of the very first stocks I bought, and because of that, in a way, it was kind of sad to let these ones go. But the reason I did this was pretty much my same reason for selling out of Apple. Both Coca-Cola and Southern Company, even though they are great companies to own, they were very small positions in my portfolio, and they'd both done pretty well for me. So I figured right now would be a pretty good time to lock in those gains, free up that money, unlock that money, and then reinvest into something else that I think has more to offer for a young dividend investor, which we'll talk more about that in just a moment. First, guys, looking at the full transaction details from selling out of Coca-Cola and Southern Company. Starting here with Coca-Cola, I had about 23 shares. With Southern Company, I had close to 18 shares, and we can see that the sale price was quite a bit above my average cost per share with both of them. So I locked in some gains with both. Looking at Coca-Cola's share price returns, I locked in a 22.5% return. On a total return basis, including dividends, it was exactly 34.5%, which is pretty solid. And then with Southern Company, the share price returns were just above 29%, and the total returns were close to 44%. So both very nice. And with the money I had from selling out of both of these positions, like I said at the beginning of the video, I did end up starting a new position in the portfolio. And I'm sure it's not going to come as much of a surprise at all to any of you guys who regularly watch my videos. But I ended up finally starting a position in Vici Properties, which is super exciting. And as we can see, Vici has a considerably higher starting yield and higher dividend growth rate than both Coca-Cola and Southern Company. So on the dividend side of things, it was a step up for sure. And now if we take a look at my brand new Vici position, guys, I was able to buy 102 shares at an average cost of $27.86, which I think is pretty solid. And instead of having two small positions, you know, at 2%, 2.3%, maybe 2.4%, I'm left with just one at 4.8%. And with that, guys, I was able to buy into Vici with a 6.1% yield, so we do get a higher yield from that. And every single year at this point in time, Vici is going to be bringing in $172.38 of dividend income. So I'm pretty stoked about all of these moves, guys. Even though I did let go of a couple of iconic companies, it feels so good to consolidate and to streamline things a bit more in the portfolio. And the cool thing is that I still have exposure to Apple through owning VU, you know, through the S&P 500, which I'm dollar cost averaging into every single week. And I still have exposure to Coca-Cola through owning SCHD, which I'm also adding to every single week. But anyway, guys, now taking a look at the before and after in the portfolio across a few different metrics like the holdings, the dividend yield, the dividend growth rate, and the annual dividend income. Starting here with the holdings, before making all these changes, I had 21 total holdings, including the two ETFs I have in my Roth IRA, SCHD and VU. But now, after this, I'm left with 19 holdings. So we're officially sub 20 holdings, which feels good. And I did see a really nice boost, both in terms of the overall portfolio yield going from 3.9% to just over 4%. So we raised it by, you know, a 0.1% there. You know, every little bit helps. And I also saw a boost looking at the dividend growth CAGR. I went from 8.13%, which I thought was pretty nice before, to almost 9%. Now, after these changes, I'm sitting at about 8.9% across the entire portfolio. I think both of these combined, the 4% yield and a near 9% dividend growth CAGR, are very solid overall dividend stats. So I'm very happy with that. And then last but not least, looking at the annual dividend income, we definitely made some nice progress here. Just from making these few tweaks, I was able to take the annual dividend income from $2,722 to now just over $2,800. We actually added $80 to the projected annual income just from making these few tweaks. So overall, you know, at least for now, this all feels like a net positive. I mean, we'll see how the returns shake out over time. I think that's going to be interesting. And even though it took me a long time to finally add Vici Properties into the portfolio, I'm really glad that I waited because I think it's looking pretty dang discounted right now, which I'm telling you more about in this next video right over here. In this one, we're going to take a much closer look at Vici Properties along with two other deeply discounted dividend stocks that all look like great pickups right now in July. So click right over here to learn more about those, and I'll see you in the next one.